What is default risk in corporate bonds for passive income? Imagine earning steady income from bonds, but suddenly the payments stop. That's what default risk is all about. It's the chance that the company you've invested in might not pay you back as promised. When you buy a corporate bond, you're lending money to a company. They agree to pay you interest regularly and return your initial investment at the end. But sometimes, companies face financial trouble. They might struggle to pay interest or even go bankrupt. If that happens, you might not get all your money back or the income you expected. Default risk varies a lot depending on the company's financial health. Big, stable companies with strong earnings usually have low default risk. Smaller or struggling companies, especially those in volatile industries, have higher default risk. Credit rating agencies give bonds a score to show how risky they are. Bonds with high ratings, called investment-grade bonds, have lower default risk. Bonds with lower ratings, known as high-yield or junk bonds, have higher default risk but pay higher interest rates to compensate. For example, a bond rated BBB is considered investment-grade and has very low chances of default. On the other hand, a bond rated BB is riskier but offers more interest. For passive income investors, understanding default risk is key. Higher risk usually means higher yields, but also more chance of losing income. If a bond defaults, it can disrupt your income flow and even cause losses. To manage this, investors should look at the issuer's financial health, their credit rating, and current market conditions. Spreading investments across different bonds with varying default risks can help balance income and safety. In short, default risk in corporate bonds is the possibility that the company won't meet its payment obligations. This risk can impact the reliability of your passive income. Picking bonds with good credit ratings and keeping an eye on the issuer's financial situation helps you build a stable income stream. Diversification is also a smart move to reduce the chances of facing problems if one company struggles. Remember, understanding default risk helps you make smarter choices and keep your passive income steady over time.